All right, let's talk about one of the most debated moves in all of investing, averaging down. Is it a brilliant strategy to buy an asset on sale, or is it just a dangerous trap that makes your losses even worse? Let's figure it out.
So just imagine this for a second. There's a stock you really believe in. You've done the homework, and suddenly, boom, it drops 30%. The pressure is on. Do you sell just to stop the bleeding? Do you hold on and pray for a comeback? Or do you double down and buy more, totally convinced you're getting the deal of a lifetime? This one question right here is what we're going to unpack. So that third option, that's what we call averaging down. The logic is super simple on the surface. You buy more shares at this new, lower price, which brings down your average cost per share. And that means you don't need the stock to recover nearly as much to get back to even. Sounds like a total no-brainer, right? Well, as you're about to see, it is way, way more complicated than that. Okay, here's our game plan. We're going to start with why this strategy is so polarizing in the first place. Then we'll get into the seductive math that pulls you in and the psychological traps that keep you there. We'll also look at the massive difference between how regular folks and the pros handle this, check out some historical home runs and total strikeouts, and then we'll wrap it all up with a playbook for how to do this the right way. All right, so let's get right into it. At its heart, the whole debate around averaging down is really a clash between two completely different philosophies of investing. And you can really see the two camps laid out here. On one side, you have the believers, the optimists. They see a price drop and think, discount. They're betting that things will bounce back, and they see buying now as a sign of contrarian strength. But on the other side, you've got the skeptics. They look at the same situation and see a sinking ship. They'd say, you're not being strategic, you're just throwing good money after bad, making an emotional decision, not a logical one. So why is this strategy so darn tempting in the first place? Well, to understand that, you've got to look at the numbers, because on paper, the math is incredibly appealing. Let's walk through a classic scenario. Say you buy 100 shares of a stock at $60 a pop. Then, ouch, it drops to $40. From that point, you now need a 50% gain just to get your money back. But what if you buy another 100 shares at the new price of $40? Well, now your average cost is just $50. Suddenly, you only need a 25% gain to break even. You've literally cut the mountain you have to climb in half. I mean, you feel like a genius, right? But here's the flip side. Let's say the stock doesn't bounce back. What if it keeps falling, down to say $35? If you had just held on to your first purchase, you'd be down $1,500. But because you averaged down, you're now down $2,000. You successfully lowered your break-even point, yes, but you also increased the total amount of money you're losing. And this is the hidden danger that the simple math doesn't show you. By doubling down, you've massively increased your exposure. Every single dollar the stock drops now costs you twice as much. See, averaging down has no mathematical floor. If the company is actually in trouble, all you're doing is accelerating your journey to a $0 position. Okay, so we've talked about the math. But let's be honest, the real danger here often isn't in the spreadsheet, it's in our own heads. The psychology of this is where it gets really tricky. There's this quote from our source material that just nails it. For a lot of people, averaging down isn't some cold, calculated financial move. It's more like an emotional security blanket, a way to cope with the stress of being wrong and seeing red in your portfolio. The thing is, our brains are basically hardwired to fall for the stuff. Studies show we feel the pain of a loss about twice as intensely as the pleasure of a gain. That's loss aversion, and it's desperately pushing you to get back to even. Then there's anchoring, where we get fixated on that original price we paid, thinking that's the real value, even if new information says otherwise. Throw in the sunk cost fallacy and the disposition effect, and you've got this perfect storm of biases that makes us hold on to our losers for way, way too long. So, this all leads to a really critical distinction. The way a typical retail investor averages down is a world away from how an institutional professional might scale into a position. They're not even playing the same game. Just look at the key words here. The retail approach is often reactive. It's driven by hope, by ego, by the pain of being wrong. The professional approach, it's systematic. It's pre-planned, and every move is about managing risk. See, they don't even call it averaging down. They call it scaling in. And the gap between these two worlds is just huge. You know, a retail investor is using their own hard-earned savings, which gets the ego all tangled up in it. They're looking at public charts and news. A big institution, they've got insane resources, alternative data, huge research budgets, complex trading algorithms. But the absolute biggest difference, it's their logic. It's completely systematic.
They decide their entry points and exactly how much they'll buy before they ever place the first trade. So does this strategy actually ever work, or is it a total fool's errand? Well, let's look at the evidence from the hard data to some of the most famous stories in market history. So this backtest on the S&P 500 is really fascinating. What it found was that a strategy of averaging down actually had a slightly lower overall return, the CAGR. But, and this is the key part, it had a much, much higher risk-adjusted return. In simple terms, it's like getting almost the same reward for taking way less risk. And for a professional managing billions, ma'am, that is a massive win. And of course, you can't talk about this without mentioning the ultimate poster child for averaging down, Amazon. During the dot-com bust, the stock got absolutely annihilated. It lost a staggering 95% of its value. But the investors who had the conviction, and frankly the stomach, to keep buying on the way down were eventually rewarded with life-changing, unimaginable returns. But, and this is a huge but, that's the danger of what we call survivorship bias. We all remember Amazon. What we forget is the massive graveyard of other dot-com companies. For every single Amazon, there were dozens of others like Webvan or Pets.com that also seemed like the next big thing. And the investors who averaged down on those stocks, they lost everything as the price went all the way to zero. And this right here, this is the statistic you have to burn into your brain. More than half, 54%, of all stocks that have a major crash never come back to their previous peak. Never. That means if you just randomly average down on a falling stock, the odds are literally stacked against you. Okay, so after all that, how can you approach this like a professional? How do you turn this potential trap into a powerful tool? That's what this final section is all about, the disciplined investor's playbook. The pros basically follow 3 non-negotiable rules. First, a fundamental check. You have to ask, is this just market panic, or is something fundamentally broken with the company itself? Second, position sizing. You must have strict limits. Will this new purchase make this one stock too big a part of your portfolio? And finally, a liquidity check. Do you have the cash and, more importantly, the time to hold on even if this stock stays down for years? And that really leaves us with the one question that matters. The next time you see one of your favorite stocks take a dive, you have to ask yourself, am I looking at a genuine discount on a great company, or am I looking at a blaring red warning sign that the story has changed for the worse? Your answer to that question is what will determine whether averaging down is a tool in your belt or a trap that's just waiting to snap.